Introduction: what this book expects to accomplish. The Intelligent Investor, first published in 1949 and revised several times through 1973, stands as one of the most influential investment books ever written in the history of financial literature. Benjamin Graham, widely regarded as the father of value investing and the mentor of Warren Buffett, wrote this comprehensive guide with a singular purpose: to help ordinary investors develop a sound framework for making investment decisions that would protect them from substantial losses while providing reasonable returns over time. The book has sold millions of copies worldwide and continues to shape the thinking of investors across generations, cementing Graham's legacy as one of the most important financial thinkers of the 20th century. Graham begins his treatise by drawing a crucial distinction that forms the foundation of his entire investment philosophy: the difference between investing and speculation. According to Graham's precise definition, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This definition, though seemingly simple on its surface, carries profound implications for how one should approach the stock market and make decisions about allocating capital. It establishes a clear standard against which all investment decisions can be measured and provides the framework for disciplined decision-making. The book explicitly states that it is not designed to make readers wealthy overnight, nor does it promise any foolproof method for consistently beating the market averages. Instead, Graham's aims are at once more modest and more achievable: to teach readers how to minimize the chances of irreversible losses that can set back financial progress by years or decades, how to maintain emotional discipline during the market extremes that inevitably occur, and how to develop a coherent framework for analyzing securities that will serve them throughout their investing lives. He emphasizes repeatedly that the main objective is not to achieve superior results, but to avoid inferior ones. Graham introduces the concept of the intelligent investor as someone who is patient, disciplined, and eager to learn from both successes and failures. Intelligence, in this context, refers not to IQ, academic credentials, or facility with mathematics, but rather to temperament: the ability to keep emotions under control and think independently when everyone else is losing their heads in either panic or euphoria. The intelligent investor recognizes that the market is not a weighing machine that precisely measures intrinsic value, but rather a voting machine that reflects the popularity and sentiment of participants. One of the most important themes Graham establishes early in the book is that investment success depends not on outsmarting other investors through superior analysis or information, but on controlling oneself and one's emotional reactions to market movements. The investor's chief problem, and even his worst enemy, is likely to be himself. This profound psychological insight, considered radical when Graham first expressed it, has been validated repeatedly by behavioral finance research conducted decades after Graham wrote these words. The introduction also acknowledges that different readers have different needs, circumstances, and risk tolerances, and that no single approach to investing is appropriate for everyone. Graham therefore establishes the framework of defensive and enterprising investors that will guide the rest of the book. The defensive investor seeks primarily to avoid serious mistakes and losses while achieving a satisfactory return with minimal effort. The enterprising investor is willing to devote significant time and care to the selection of securities that are both sound and more attractive than average. Graham's approach throughout the book is fundamentally conservative in the best sense of that word. He seeks to conserve capital, to protect investors from their own worst tendencies, and to ensure that anyone who follows his principles conscientiously will achieve satisfactory results over the long term. The book does not promise excitement or quick riches. Instead, it offers something far more valuable: a proven roadmap to financial security based on time-tested principles. Chapter 1: Investment versus Speculation. Graham opens his first chapter by addressing what he considers the most fundamental question in all of investing: what constitutes genuine investment as opposed to mere speculation. This critical distinction, which he first articulated in his 1934 masterwork Security Analysis, becomes the bedrock upon which all subsequent investment advice rests. Understanding this distinction thoroughly is essential for anyone who wishes to achieve lasting success in the financial markets, rather than merely experiencing occasional lucky wins followed by devastating losses. The chapter provides Graham's classic and oft-quoted definition. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these three requirements are speculative, regardless of how sophisticated they may appear or how confident the participant may feel. Each element of this carefully constructed definition carries significant weight. The requirement for thorough analysis means that facts must be investigated systematically before purchasing securities. Safety of principal means protection against permanent loss of capital. Adequate return means acceptable profit given the risks involved. Graham observes with evident concern that the distinction between investment and speculation has become increasingly blurred over the years, particularly on Wall Street, where commission income often depends on trading activity regardless of whether that activity benefits clients. He criticizes sharply the tendency to call anyone who buys stocks an investor, regardless of what they buy, how they buy it, what price they pay, or what their expectations are. This confusion of terminology has led countless people to suffer substantial and often permanent losses. The chapter discusses in considerable detail the expected results for the intelligent investor who follows Graham's principles. He emphasizes repeatedly that the investor should not expect to achieve significantly better than average results consistently over long periods of time. The goal should be to achieve results equal to or somewhat better than those of the stock market as a whole, while avoiding the serious losses that can devastate long-term wealth accumulation. For the defensive investor who lacks the time, interest, or expertise for active security selection, Graham recommends a straightforward portfolio split between high-quality bonds and high-quality common stocks. The basic allocation should be between 25% and 75% in common stocks, with the remainder in bonds, adjusted based on market conditions and personal circumstances. This flexibility within defined boundaries allows investors to respond to changing valuations while maintaining discipline. For the enterprising investor willing to devote significant time and effort to investment analysis, Graham suggests that outperformance relative to market averages is possible, but acknowledges that it is difficult to achieve consistently over extended periods. He warns emphatically that the pursuit of superior returns often leads investors into speculative territory without their realizing it until significant losses have been incurred. The key is to be ruthlessly honest with oneself about one's capabilities and limitations. Graham addresses the psychological dimension of the investment speculation distinction with unusual insight. Speculators often convince themselves that they are investing because their purchases are based on some form of analysis that feels sophisticated to them. But analysis that ignores the price being paid, that relies on predictions of market movements rather than assessment of fundamental value, or that depends on finding greater fools willing to pay higher prices, is not true investment analysis. Chapter 2. The Investor and Inflation. Inflation represents one of the most significant and insidious risks facing long-term investors, and Graham devotes this entire chapter to examining its corrosive effects on investment returns and the various strategies investors can employ to protect themselves. This discussion remains remarkably relevant many decades after it was written, as inflation continues to erode purchasing power in ways that many investors fail to appreciate until it is too late. Graham begins his analysis by presenting historical data on inflation rates and their impact on both bond and stock returns over many decades of financial history. He notes that while inflation was relatively modest during much of the early 20th century, it accelerated significantly during and after World War II, reaching levels that surprised and damaged many investors who had complacently assumed that past price stability would continue indefinitely. The chapter examines in detail the common belief that common stocks are a reliable hedge against inflation. Graham's careful analysis reveals a far more nuanced and sobering picture than the conventional wisdom suggests. While it is true that stocks have generally outperformed bonds during inflationary periods over sufficiently long time horizons, the relationship is not nearly as straightforward or reliable as many investors assume. Graham presents data that challenges the comfortable assumption that corporate profits naturally keep pace with inflation. His analysis shows that corporate profits as a percentage of invested capital have not shown a consistent tendency to increase during inflationary periods. This observation challenges the popular notion that companies can simply pass along higher costs to consumers and thereby maintain their real profit margins regardless of how severe inflation becomes. The chapter discusses in some detail the impact of inflation on the price-to-earnings ratios that investors are willing to pay for stocks. Graham observes that during periods of high inflation, investors often become more cautious about paying high multiples for earnings that may be eroded by rising prices, and that may be overstated in nominal terms due to inadequate depreciation charges. Graham considers with his characteristic skepticism various alternative investments that have been proposed as inflation hedges over the years, including real estate, gold, and collectibles. He approaches each of these alternatives with considerable caution, noting that each has its own set of risks and limitations that enthusiasts often overlook. The chapter concludes with practical recommendations for the typical investor facing inflation risk throughout a long investment lifetime. Graham suggests that a balanced portfolio consisting of both stocks and high-quality bonds remains the most sensible approach for most investors. He emphasizes that no investment strategy yet devised can completely eliminate inflation risk. Chapter 3. A Century of Stock Market History. This substantial chapter provides a broad historical perspective on stock market performance and valuation, using data from the late 19th century through the early 1970s to illustrate patterns that recur throughout market history with remarkable consistency. Graham's purpose in presenting this history is not merely to educate readers about past events, but to demonstrate how understanding past patterns can inform present decisions. Graham traces the major bull and bear markets over the preceding century, highlighting the enormous swings in both prices and valuations that have characterized stock market history throughout its entire existence. He shows convincingly that the market has experienced numerous cycles of euphoria and despair, with prices sometimes rising to levels that could not possibly be justified by any reasonable assessment of underlying business fundamentals. The chapter examines in considerable detail the relationship between stock prices and underlying business fundamentals, such as earnings, dividends, and book values. Graham presents extensive data showing how price-to-earnings ratios have varied dramatically over time, ranging from single digits during periods of extreme pessimism to double digits or higher during periods of unbridled optimism. Graham discusses the concept of dividend yield as a useful valuation metric that has proven informative throughout market history. He notes that dividend yields have historically provided important information about overall market valuation levels. When dividend yields are unusually low relative to historical norms, it typically indicates that stock prices are elevated relative to the income they produce. The chapter presents Graham's assessment of market conditions as of early 1972, when this revised edition of the book was being prepared for publication. He notes with evident concern that stock prices had risen substantially from earlier levels and that valuations appeared significantly elevated by historical standards. While he prudently stops short of predicting a specific market crash, he counsels investors clearly to be cautious. Graham emphasizes throughout the chapter that market history should teach investors humility about their ability to predict future market movements. While broad patterns and cycles tend to repeat over sufficiently long periods, the specific timing of market tops and bottoms is notoriously difficult to predict with any useful reliability. Chapter 4. General Portfolio Policy. The Defensive Investor. This important chapter introduces the first of Graham's two investor archetypes, the defensive investor. The defensive investor is someone who seeks a good investment result with minimal effort, worry, and time commitment, recognizing honestly that most people have neither the time, the temperament, nor the genuine expertise required for active investment management. Graham's core recommendation for the defensive investor is to maintain a portfolio divided simply between high-grade bonds and high-grade common stocks, providing exposure to both of the two major asset classes while avoiding more exotic investments. The basic allocation between stocks and bonds should be adjusted within the range of 25% to 75% in stocks, with the remainder in bonds, never going to either extreme. The standard recommendation for most defensive investors is a simple 50-50 split between stocks and bonds, which provides reasonable balance between the long-term growth potential of stocks and the stability and income provided by high-quality bonds, while dramatically simplifying decision-making and reducing the temptation to time markets based on predictions that are almost always wrong. The chapter provides detailed guidance on when and how to adjust this basic stock-bond allocation based on objective market conditions rather than subjective feelings. Graham suggests increasing the bond allocation toward the higher end of the permitted range when stocks appear significantly overvalued by historical standards, and increasing the stock allocation when stocks appear significantly undervalued. Graham discusses at some length the types of bonds that are suitable for the defensive investor's portfolio. He recommends government bonds for their near-absolute safety and high-grade corporate bonds for their modestly higher yields, while warning emphatically against the temptation to reach for higher yields through lower-quality bond issues that carry meaningful default risk. For the stock portion of the defensive investor's portfolio, Graham recommends broad diversification across a range of high-quality issues selected according to objective criteria that eliminate speculation. The defensive investor should own shares in no fewer than 10 different companies across various industries and should strictly avoid concentrated positions in any single stock. The chapter concludes with an important discussion of the psychological requirements of defensive investing. The defensive investor must be emotionally willing to accept average market returns in exchange for peace of mind and freedom from constant worry about portfolio management. Chapter 5. The Defensive Investor and Common Stocks. Building carefully on the framework established in the previous chapter, Graham now provides detailed and specific guidance on selecting common stocks for inclusion in the defensive investor's portfolio. This practically oriented chapter offers specific, objective criteria that can be applied almost mechanically to identify suitable investments without requiring extensive financial expertise. Graham presents his famous 7 criteria for stock selection by the defensive investor, each designed specifically to eliminate unnecessary risk and ensure a focus on quality. The first criterion is adequate size. Companies selected should be large enough to have demonstrated staying power and competitive strength. Second is a sufficiently strong financial condition to survive economic difficulties. Third is earnings stability, positive earnings for each of the past 10 years. Fourth is an uninterrupted dividend record, dividends paid every year for at least 20 years. Fifth is earnings growth. Per share earnings should have increased by at least 1/3 over the past 10 years. Sixth is a moderate price-to-earnings ratio. The current price should not exceed 15 times average earnings over 3 years. Seventh is a moderate ratio of price to assets. Graham acknowledges that these criteria are somewhat arbitrary and that investors may modify them based on circumstances. However, some objective standards are necessary to maintain discipline and prevent emotional decision-making. The specific numbers matter less than the principle of having predetermined criteria and adhering to them. The chapter discusses practical implementation, noting that relatively few stocks will meet all requirements at any given time. Graham suggests this is a feature rather than a bug. A rigorous screening process ensures that only the most conservative companies make it into the defensive portfolio. Chapter 6. Portfolio Policy for the Enterprising Investor, Negative Approach. Graham now turns his attention to the second of his two investor archetypes, the enterprising investor. The enterprising investor is someone who is genuinely willing to devote significant time, effort, and attention to security analysis in the hope of achieving better-than-average investment results. However, rather than immediately discussing what such an investor should do, Graham first addresses at considerable length what such an investor should definitely not do. The chapter begins with a stern warning against second-grade bonds and preferred stocks that offer higher yields than first-grade issues. While these lower-quality securities may initially seem attractive to income-seeking investors, Graham argues forcefully that the extra income very rarely compensates adequately for the significantly increased risk of partial or total loss. Graham advises strongly against buying bonds during bear markets simply for the sake of capturing higher yields as prices fall. While bond prices do indeed fall during periods of economic distress, often reflecting legitimately increased default risk, the investor who attempts to profit from these declines is engaging in speculation rather than investment. The chapter discusses foreign government bonds with considerable skepticism. While foreign sovereign bonds may sometimes offer yields higher than comparable domestic issues, they carry unique risks that are extremely difficult for the typical investor to assess properly. Graham issues an emphatic warning against new issues of common stocks, particularly initial public offerings that come to market with extensive promotional fanfare. He observes that new stock issues tend systematically to come to market during periods of general market enthusiasm, when companies can obtain favorable prices from eager investors. The chapter cautions in the strongest terms against the temptation to buy popular growth stocks at any price, no matter how exciting the company's story may be. While growth stocks have undeniably produced spectacular gains for some fortunate investors, they also carry substantial risks that are chronically underestimated by enthusiastic investors. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. Having thoroughly established what the enterprising investor should carefully avoid, Graham now turns to the positive side. What strategies are actually available for achieving better-than-average investment results with acceptable risk? He approaches this important topic with characteristic caution, acknowledging that consistent outperformance is genuinely difficult to achieve and that many strategies that appear promising in theory fail when actually implemented. Graham identifies the systematic purchasing of bargain issues as the single most reliable approach available to the enterprising investor seeking above-average returns. A bargain issue, in Graham's precise definition, is a security that appears, based on objective analysis of its fundamental characteristics, to be worth substantially more than its current market price. The most compelling and mathematically obvious bargains available to the enterprising investor are common stocks selling at prices below their net current asset value per share. Net current asset value is calculated by subtracting all of a company's liabilities from its current assets alone, while completely ignoring the value of any fixed assets. A stock selling below this stringent measure of liquidation value presents an extraordinary opportunity. The chapter also examines several secondary criteria that can be useful for identifying potential bargain situations when stocks do not meet the extremely stringent net current asset value test. These secondary criteria include stocks selling at unusually low multiples of current earnings, stocks selling significantly below book value despite solid financial positions, and stocks of fundamentally sound companies experiencing temporary business difficulties. Graham discusses frankly the significant psychological challenges facing the enterprising investor who attempts to implement a disciplined bargain hunting approach. Stocks meeting bargain criteria are almost by definition unpopular issues that have fallen from grace due to recent business problems, negative publicity, or simply a complete lack of attention from Wall Street analysts. The enterprising investor must be psychologically prepared to act contrary to prevailing market sentiment. Chapter 8: The Investor and Market Fluctuations. This landmark chapter, widely regarded as one of the most important chapters in all of investment literature, addresses the critically important topic of the investor's psychological relationship with the inevitable fluctuations that characterize all financial markets. In this chapter, Graham introduces his famous allegory of Mr. Market, which has become one of the single most influential concepts in investment thinking and has guided countless successful investors, including Warren Buffett. Graham begins the chapter by observing that investors face two fundamentally different questions regarding how to respond to market fluctuations. The first question is whether the investor should attempt to profit from market fluctuations through timing, systematically buying when prices appear low and selling when prices appear high. The second question is whether the investor should attempt to identify individual securities that are currently mispriced relative to their intrinsic value. Regarding the first question of market timing, Graham expresses considerable skepticism despite the obvious intuitive appeal of buying low and selling high. While he acknowledges that some investors have profited from timing strategies over certain periods, he believes firmly that most such efforts are likely to fail because they depend fundamentally on predicting what is inherently unpredictable. Graham then introduces what has become his most famous contribution to investment thinking, the concept of Mr. Market. Mr. Market is an imaginary but highly instructive business partner who appears faithfully every single day to offer either to buy your interest in a shared business or to sell you his interest at whatever price he happens to quote that particular day. Mr. Market is extraordinarily obliging and never takes offense. You can choose to take advantage of his offers when they seem attractive, or you can ignore them entirely when they seem foolish. The key and transformative insight of the Mr. Market allegory is that the intelligent investor should view market price quotations as a servant to be used when convenient rather than as a master whose judgments about value must be followed. The market exists fundamentally to serve the investor by providing daily opportunities to buy and sell securities, not to instruct the investor about what those securities are actually worth. Graham emphasizes colorfully that Mr. Market suffers from what appear to be incurable emotional problems that make him an extremely poor and unreliable guide to intrinsic value, but simultaneously an excellent source of opportunities for the disciplined investor. At certain times, Mr. Market is wildly euphoric and can see only favorable factors, causing him to offer prices far above any reasonable estimate of intrinsic worth. At other times, Mr. Market is deeply depressed and can see nothing but trouble ahead. The chapter discusses with unusual psychological insight the formidable challenges that investors face during periods of market extremes. When stock prices are rising rapidly day after day, the temptation to join in and participate in what appears to be easy money becomes almost irresistible. When stock prices are falling sharply and losses accumulate daily, the urge to sell everything before things get even worse can become absolutely overwhelming. Graham argues compellingly that these powerful emotional responses are precisely backwards. Graham addresses at considerable length the critically important relationship between market price and intrinsic value that lies at the heart of all intelligent investing. While market prices fluctuate constantly based on news events, economic reports, and changes in sentiment, the intrinsic value of a business changes much more slowly and predictably based on fundamental factors such as sustainable earning power, dividend-paying capacity, asset values, and competitive position. The chapter provides practical guidance for dealing with market fluctuations. Graham recommends strongly that investors establish clear, predetermined rules for their own behavior during market extremes before those extremes actually arrive and emotions cloud judgment. By carefully deciding in advance what specific actions to take under various clearly defined conditions, investors can largely avoid the emotional decision-making that leads so many to buy at tops and sell at bottoms. Graham concludes this crucially important chapter with a profound observation. The investor's worst enemy is not the market itself, not the economy, not interest rates, not inflation, but rather the investor himself. The market offers countless opportunities for profit to those investors who possess the discipline to analyze value independently and to take advantage of Mr. Market's emotional mood swings. But the market also offers countless temptations to loss for those who lack such discipline. Chapter 9. Investing in Investment Funds. Graham devotes this practical chapter to mutual funds and other pooled investment vehicles, recognizing realistically that for a great many investors, these professionally managed vehicles offer a sensible alternative to direct individual stock selection. While Graham was writing before the later explosion of the mutual fund industry, and well before the creation of low-cost index funds, his careful analysis of professional investment management remains highly relevant. The chapter begins by clearly distinguishing between open-end mutual funds, which continuously issue new shares and redeem existing shares at net asset value calculated at the end of each trading day, and closed-end funds, which issue a fixed number of shares that subsequently trade on stock exchanges at market prices that may differ substantially from the underlying net asset value. Graham examines with characteristic objectivity the actual long-term performance record of professionally managed investment funds. He presents data showing convincingly that most mutual funds have failed to outperform the unmanaged market averages over extended periods of time after properly accounting for their management fees and other expenses. The chapter provides practical guidance for investors who choose to invest through mutual funds despite their limitations. Graham suggests that fund investors should focus their attention on funds with low expense ratios, funds with long and consistent track records, and funds with clearly articulated investment philosophies consistent with the investor's own approach. Chapter 10. The Investor and His Advisors. This practically oriented chapter addresses the important role of professional investment advisors in the typical investor's decision-making process. Graham recognizes realistically that a great many investors lack the time, the inclination, or the genuine expertise needed to manage their own investment portfolios effectively, and must therefore rely to some degree on others for guidance and assistance. Graham identifies and describes several distinct categories of investment advisors that operate under different business models and face different potential conflicts of interest. Investment counselors manage client portfolios directly for fees typically based on assets under management. Brokerage firms employ registered representatives who earn commissions on securities transactions. Banks offer trust and investment management services. Financial planners sell various financial products. The chapter examines frankly what investors can and should realistically expect from their professional advisors. Graham argues that most investment advisors, despite their claims and credentials, cannot consistently outperform unmanaged market averages. The genuine value of a truly good investment advisor lies not in delivering superior investment returns, but rather in helping clients maintain discipline through difficult market periods. Graham emphasizes the critical importance of maintaining an independent perspective, even when working with trusted professional advisors. The ultimate responsibility for major investment decisions rests permanently with the investor and cannot effectively be delegated to others regardless of their expertise. Chapter 11. Security Analysis for the Lay Investor. In this educational chapter, Graham introduces the fundamental concepts and principles of security analysis, providing a practical framework that ordinary non-professional investors can use to evaluate potential investments without requiring advanced financial training. While professional security analysis, as practiced on Wall Street, can be extraordinarily complex, Graham demonstrates that the basic underlying principles are accessible to anyone with reasonable intelligence. The chapter begins by carefully defining security analysis as the systematic examination of available facts about a security with the specific purpose of drawing reasonable conclusions about its current value and future prospects that can inform intelligent investment decisions. Graham presents the centrally important concept of intrinsic value, which he defines as the value that would be justified by the objective facts about a security, including tangible assets, earning power, dividend-paying capacity, and reasonably definite future prospects, as carefully distinguished from the current market quotation. The chapter introduces Graham's central concept of the margin of safety, which he considers the single most important idea in all of investment. The margin of safety is simply the favorable difference between the price actually paid for a security and the analyst's careful estimate of its intrinsic value. Chapter 12. Things to consider about per-share earnings. Earnings per share is perhaps the single most widely followed metric in all of stock market analysis, and Graham devotes this important chapter to helping investors understand its true meaning, its significant limitations, and its proper use in making sound investment decisions. Graham begins by observing that the calculation of earnings per share, while appearing straightforward and objective on its surface, actually involves numerous significant accounting judgments and choices that can substantially affect the finally reported result. Different companies operating in similar businesses may use quite different accounting methods. The chapter examines in detail the important distinction between operating earnings from ongoing normal business activities and various non-recurring items that may significantly affect reported earnings in any single period. Companies frequently report special charges, restructuring costs, asset write-downs, and gains or losses that affect reported earnings, but do not reflect sustainable ongoing earning power. Graham provides detailed practical guidance on the proper use of earnings multiples for valuing common stocks. He suggests strongly that investors should use average earnings over several years rather than the most recent single year's earnings when calculating meaningful price-to-earnings ratios. Chapter 13. A comparison of 4 listed companies. In this instructive chapter, Graham demonstrates the practical application of security analysis principles through a detailed side-by-side comparison of 4 actual publicly traded companies with real historical financial data. This extended case study approach allows readers to observe directly how the theoretical concepts discussed in previous chapters actually work in practice. The chapter presents 4 companies drawn from different industries, each with distinct business characteristics, competitive positions, and investment profiles. Graham systematically examines their financial statements, carefully calculates all relevant analytical ratios and metrics, and thoughtfully assesses their relative investment merits. Graham calculates and presents key financial ratios for each of the 4 companies, including price-to-earnings ratios, price-to-book value ratios, current dividend yields, debt-to-equity ratios, and various measures of profitability and financial strength. The chapter concludes with Graham's overall investment assessment of each of the 4 companies, thoughtfully ranking them according to their attractiveness as current investment opportunities, and explaining in detail the reasoning behind his specific rankings. Chapter 14. Stock Selection for the Defensive Investor. Graham returns in this chapter to the practical concerns of the defensive investor, providing detailed and specific guidance on actually implementing the stock selection criteria discussed comprehensively in earlier chapters. This chapter bridges the important gap between theoretical principles and actual real-world investment practice. The chapter carefully reviews the 7 specific criteria for defensive stock selection that Graham established earlier: adequate company size, sufficiently strong financial condition, consistent earnings stability, an uninterrupted dividend record, meaningful earnings growth, a moderate price-to-earnings ratio, and a moderate price-to-book ratio. Graham addresses the important practical question of appropriate diversification for the defensive investor. He recommends firmly that defensive investors hold positions in at least 10 different stocks distributed across various industries to ensure adequate protection against both company-specific risks and industry-specific risks. The chapter discusses practical considerations around the timing of stock purchases and sales for the defensive investor. While Graham acknowledges that buying stocks during general market downturns can meaningfully improve long-term investment returns, he warns strongly against waiting indefinitely for the theoretically perfect moment. Chapter 15. Stock Selection for the Enterprising Investor. Graham now provides detailed and specific guidance for the enterprising investor who is genuinely willing to devote significant time, effort, and attention to achieving better-than-average investment results through more intensive security analysis and more disciplined stock selection. Graham presents his criteria for systematically identifying bargain stocks, which he considers the single most reliable approach available to enterprising investors seeking above-average returns. The most mathematically compelling bargains remain those relatively rare stocks selling at prices below their calculated net current asset value per share. The chapter examines various secondary criteria that can be useful for identifying potential bargain opportunities in situations where stocks do not meet the extremely stringent net current asset value test. These secondary indicators include stocks currently selling at unusually low multiples of recent earnings and stocks selling significantly below stated book value. Graham discusses portfolio construction considerations specific to the enterprising investor. While appropriate diversification remains important for prudent risk management, the enterprising investor can reasonably afford to maintain somewhat more concentrated positions than the purely defensive investor. Chapter 16. Convertible Issues and Warrants. In this specialized chapter, Graham examines convertible securities and stock warrants, which occupy an interesting middle ground between common stocks and bonds, and consequently offer investment characteristics of both asset classes. These hybrid securities can potentially be appropriate in certain specific circumstances for sophisticated investors. The chapter explains in detail the basic mechanics of convertible bonds, which are corporate bonds that give the holder the contractual right to convert each bond into a specified number of shares of the issuing company's common stock at any time before the bond's maturity date. Graham discusses the proper valuation of convertible bonds, which depends simultaneously on both their bond value component and their conversion value component. The bond value is what the convertible bond would theoretically be worth if it had no conversion feature at all. Graham presents a notably skeptical view of stock purchase warrants as appropriate investment vehicles for typical investors. Unlike convertible bonds, warrants have no bond value component whatsoever to provide downside protection. Chapter 17. 4 extremely instructive case histories. In this memorable chapter, Graham presents 4 detailed case studies drawn from actual market history, each carefully selected to illustrate important and lasting lessons about proper investment analysis and the very real dangers of speculation that emerge when investors abandon sound principles in pursuit of easy gains. The first and most dramatic case history examines Penn Central, the railroad conglomerate that declared bankruptcy in June 1970 in what was at that time the largest corporate bankruptcy in American history. Graham shows methodically how careful analysis of Penn Central's publicly available financial statements would have clearly revealed the company's rapidly deteriorating financial situation. Graham uses the Penn Central case specifically to illustrate the critical importance of examining actual cash flow carefully in addition to reported accounting earnings. The company had been paying cash dividends to shareholders from accounting profits even while its actual operating cash flow was deeply negative. The remaining 3 case histories examine other well-known companies that experienced dramatic and painful failures after extended periods of apparent success that had been built substantially on accounting illusions and promotional hype rather than genuine underlying business value. Chapter 18. A comparison of 8 pairs of companies. In this analytically rich chapter, Graham presents a comprehensive comparative analysis of 8 carefully selected pairs of companies, convincingly illustrating how apparently similar businesses operating in the same industries can nevertheless offer vastly different investment propositions. Graham structures each of the 8 comparisons to highlight specific and important lessons about sound security analysis. In each pair examined, one company represents a clearly more attractive investment opportunity than the other, even though both companies operate in the same general industry. The 8 comparisons demonstrate convincingly that market price and true investment value frequently diverge substantially, creating profitable opportunities for analytical investors willing to do careful homework. In several of the pairs examined, the less well-known company turns out to offer substantially better investment value. Graham concludes the chapter by emphasizing that systematic comparative analysis is a powerful and underutilized tool for investors seeking to identify relative mispricings in the market that may not be apparent when examining individual companies in isolation. Chapter 19. Shareholders and Managements. Dividend Policy. In this chapter on corporate governance, Graham addresses the important relationship between shareholders as the legal owners of corporations and the professional managers who actually run those corporations on a day-to-day basis, with particular attention to dividend policy. The chapter begins by observing candidly that while shareholders are indeed the legal owners of corporations under the law, their practical power and influence over corporate decision-making is actually quite limited in most real-world situations. Graham discusses dividend policy at considerable length, arguing persuasively that shareholders should generally prefer companies that commit to paying substantial and regular cash dividends rather than retaining all earnings for reinvestment at management's sole discretion. The chapter encourages shareholders to take their ownership responsibilities seriously and to be genuinely active and engaged owners who attend annual meetings, vote their proxy ballots thoughtfully, and communicate directly with corporate management when they disagree with significant corporate decisions. Chapter 20. Margin of Safety as the Central Concept of Investment. Graham devotes this climactic and crucially important chapter to explaining and emphasizing what he considers without qualification the single most important concept in all of investment, the margin of safety. This fundamental principle, which runs as a consistent thread throughout the entire book, receives its fullest and most emphatic treatment here. Graham defines the margin of safety precisely as the favorable difference between the price actually paid for a security and the analyst's careful and conservative estimate of that security's intrinsic value. When an investor purchases a security for substantially less than objective analysis suggests it is worth, the investor has established a margin of safety that provides essential protection. The chapter explains comprehensively why the margin of safety is absolutely necessary for successful investing over any meaningful period of time. Security analysis, no matter how careful, thorough, sophisticated, or expertly performed, necessarily involves estimates, projections, assumptions, and forecasts about the future that may well prove incorrect when actual events unfold differently. Graham illustrates the margin of safety concept clearly with the example of bond investing, where the application of the principle is most straightforward. A corporate bond offers an adequate margin of safety when the issuer's sustainable earning power substantially exceeds the interest payments required to service the debt. The chapter carefully extends the margin of safety concept to the more challenging domain of common stock investment, where its application requires more judgment, but is equally or even more important given the substantially greater uncertainty inherent in equity ownership compared to bond ownership. Graham emphasizes repeatedly that the margin of safety emphatically does not guarantee success in any individual investment decision, nor does it promise that every stock purchased according to these principles will prove profitable. The margin of safety is fundamentally a portfolio principle that ensures satisfactory aggregate results over time across many investments. The chapter discusses the essential relationship between the concept of diversification and the margin of safety concept. Adequate diversification across multiple investments is necessary precisely because the margin of safety on any individual investment merely makes the odds of profit favorable without guaranteeing success in any particular case. Graham draws a fundamental and critically important distinction between true investment and mere speculation based squarely on the margin of safety concept. An investment operation is one in which a satisfactory return appears reasonably assured on the basis of careful analysis and an adequate margin of safety. Graham concludes this crucial chapter by emphasizing that the margin of safety serves dual purposes as both an eminently practical tool for making better investment decisions in specific situations and as a philosophical foundation for approaching the entire investment process with appropriate intellectual humility. Conclusion: comprehensive analysis and reflections. Benjamin Graham's The Intelligent Investor, despite having been written many decades ago in a world that was very different from our own in countless ways, continues to offer investment wisdom that is remarkably and directly applicable to modern investing in today's markets. The fundamental principles that Graham articulated so clearly throughout this important book, including the critical distinction between genuine investment and mere speculation, the absolute importance of maintaining an adequate margin of safety, the brilliantly instructive market allegory, and the essential necessity of emotional discipline, remain every bit as relevant and valuable today as when they were first written. The book's enduring value lies not in any specific stock recommendations or market predictions, which would naturally become dated and obsolete, but rather in its comprehensive and timeless framework for thinking clearly and rationally about investment decisions under conditions of genuine uncertainty. Graham teaches readers how to think systematically about investment problems rather than merely telling them what to think about specific situations. This educational approach ensures that the fundamental principles remain useful and directly applicable even as markets evolve, new financial instruments are created, and economic conditions change. Financial markets have evolved dramatically since Graham wrote his masterwork, with the rise of low-cost index funds providing simple diversified exposure to entire markets, the proliferation of exchange-traded products, the growth of algorithmic and high-frequency trading, changing market dynamics, and the complete democratization of financial information through the internet. Yet human nature remains constant across the generations, and it is human nature that Graham addresses most fundamentally. Fear, greed, overconfidence, impatience, envy, and the powerful desire for easy riches continue to drive investor behavior and create opportunities for those disciplined few who maintain their composure. Key themes and their application to modern investing. Several key themes emerge clearly from Graham's comprehensive work that deserve careful emphasis for any investor seeking to apply his timeless principles successfully. First, and perhaps most important, is the essential distinction between market price and intrinsic value that underlies all truly intelligent investing. The market provides prices continuously, updating them second by second throughout each trading day, but the intelligent investor must determine value independently through careful analysis of fundamental business characteristics rather than simply accepting the market's verdict. Second is the absolute necessity of maintaining genuine emotional discipline in all market conditions, whether characterized by euphoria or despair. Graham understood decades before behavioral finance became a recognized academic field that the investor's most dangerous enemy is almost always himself or herself rather than any external market force. The ability to remain genuinely calm during market panics, to buy enthusiastically when everyone else is selling in fear, to sell prudently or simply stand aside when everyone around is buying eagerly in greed, separates successful investors from the vast majority who destroy their wealth over time. Third is the concept of margin of safety as the essential foundation of all sound investment practice and the indispensable protection against the irreducible uncertainty of an unknowable future. No analysis, however thorough, careful, sophisticated, or expertly performed, can possibly eliminate the inherent uncertainty involved in committing capital today in expectation of future returns that depend on events that have not yet occurred. Fourth is the critical importance of matching investment strategy honestly to individual temperament, circumstances, available time, genuine expertise, and realistic self-assessment. Graham's thoughtful distinction between defensive and enterprising investors acknowledges clearly that quite different investment approaches suit different people based on their particular situations. Acknowledged criticisms and limitations. While Graham's foundational work remains invaluable for serious investors and fully deserves its classic status, intellectual honesty requires acknowledging certain limitations that have become apparent over subsequent decades. Some of Graham's most specific quantitative screening techniques have become substantially less practical as markets have become more informationally efficient and institutional investors have systematically exploited the most obvious statistical bargains. Additionally, Graham's considerable emphasis on quantitative factors derived from financial statements may somewhat underweight the practical importance of qualitative factors that his most famous student Warren Buffett has increasingly emphasized. Sustainable competitive advantage, the integrity of senior management, the strength of brand names, network effects, and switching costs all matter enormously for long-term investment results, but are difficult to capture in Graham's largely quantitative screens. The book also inevitably reflects its particular historical era in certain analytical approaches that may require thoughtful updating for successful modern application. Accounting standards have changed significantly since Graham wrote. Entirely new types of businesses have emerged that may require modified analytical frameworks Graham did not address. Final thoughts on achieving investment success. The Intelligent Investor thoroughly deserves its well-established reputation as one of the most important investment books ever written, and should be carefully studied by every serious investor who genuinely seeks long-term success. Benjamin Graham's remarkable combination of analytical rigor developed over decades of professional practice, deep psychological insight into human nature, and hard-won practical wisdom accumulated through both successes and failures provides a comprehensive foundation that can serve investors faithfully throughout their entire investing lives. Perhaps the single most important lesson of this entire remarkable book, the essential truth that makes all of the technical lessons actually possible to implement in practice, is that successful investing over the long term genuinely does not require genius-level intelligence, access to exceptional information, mathematical brilliance, sophisticated computer models, or complicated strategies available only to hedge fund professionals. What successful investing fundamentally requires above all else is the discipline to follow sound and proven principles consistently, the patience to allow sufficient time for intrinsic value to be recognized, and the emotional fortitude to control one's own psychological reactions when everyone around appears to have lost their heads. Graham's timeless work reminds us powerfully that investing at its core is simply about allocating capital wisely over extended periods of time in ways that are likely to produce satisfactory returns, while carefully avoiding the catastrophic permanent losses that can set back financial progress by years or decades. This seemingly modest and achievable goal turns out to be actually quite difficult to accomplish in practice, as the market constantly tempts investors into speculation disguised as investment, into overconfidence about their own abilities, into excessive trading that generates costs but not returns, and into emotional decision-making at precisely the moments when calm rationality is most needed. The intelligent investor who carefully heeds Graham's timeless lessons, who maintains genuine independence of thought when the crowd rushes in one direction or another, who insists always on an adequate margin of safety before committing capital, who keeps a firm grip on emotions during inevitable periods of market turmoil, can successfully avoid most of the common pitfalls that destroy investor wealth and can achieve the satisfactory long-term results that elude so many others. The investment path that Graham illuminates may lack the excitement and drama of more aggressive approaches that promise quick riches, but it offers something far more valuable: a proven and time-tested roadmap to building genuine and lasting wealth while maintaining peace of mind. That is the true essence of intelligent investing as Benjamin Graham taught it, and it remains as valid today as when he first set pen to paper.